Good morning. Welcome to Stock Market Today, Monday, March 25th, 2019. I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email to follow along with this show and get daily stock ideas to consider, all hitting your inbox before the market opens each trading day. So we're going to dive right in now. S&P 500 finished lower in Friday's trading near the worst levels, pulling the major indexes lower on the week. Materials, financials, and energy were the worst performers. Defensive sectors outperformed. Remember, we've been bullish on utilities and real estate. Treasuries were stronger across the curve with more curve flattening. The dollar was stronger against the euro, but weaker against the yen and sterling. Gold up 40 basis points. WTI crude finished down 1.6% on Friday. Your outperformers, utilities only group to finish higher. Staples, REITs, and telecom outperformed. Underperformers, materials, financials, energy, and tech. As we get to the desk this morning, futures are down 20 basis points after finishing mostly lower last week. Asian equities were weaker overnight. Japan down over 3%, and China was off nearly 2%. European markets are mixed this morning. Treasuries are weaker after that big rally last week. Dollar was stronger versus the yen and sterling, lagging the euro. Gold up 40 bips, and WTI crude is weaker. And there's the chart, right, folks? S&P 500 hit resistance at the 2850 level. We'll now mark that as the bottom end of resistance. 2850 to 2875 is your resistance range. Support 2750 to 2775. You can see the rising 200-day rising it's relatively flat actually at 2755. So as those growing global growth concerns, we got some flash PMI data on Friday. Some weakness in the Eurozone really weighed on sentiment here in the U.S. We closed near the lows of the day. Now, the RSI remains in bullish ranges, so that's constructive. We're going to look for these pullbacks, 2750 to 2775. Same type setup. When we pulled back here to 2725, the RSI stayed in bullish ranges. We'll look for the same type setup here to become aggressive on the long side of the portfolio. I think we could see some near-term choppiness or weakness. Now, Chaikin money flow did dip into bearish ranges, especially with that really weak close on Friday, ever so slightly. We'll see if it can reverse itself. But to me, this RSI is what's really important from a momentum and trend perspective. We want to see the markets kind of hold above these support levels while RSI remains in bullish ranges for us to really get aggressive on the long side of the portfolio and start adding bullish and very bullish stocks from leading sectors and industry groups when those stocks become oversold. So right now, not as aggressive on the long side. From a strategic standpoint, we're still bullish, but from a tactical near-term standpoint, our proprietary indicator has the market overbought, so we're not going to be as aggressive here in the near term. Now, your market in a minute, stocks fade on growing global growth fears. We talked about that. Small caps continue to underperform. They were the big underperformer last week, especially on Friday. We'll take a look at that in a moment. 10-year yields fall below 2.45%, and that did pressure the financials. Commodities rally as the dollar pulled back. Futures do point to a lower open here today, as I said. Now, your power bars for 3 out of the 4 major groups are still skewed to the bullish side. Now, the Dow is down 1.76%, but the power bar is still 7-4 in favor of the bulls. S&P 500 down 1.8%, 110 bulls, 75 bears. NASDAQ still greater than 2-to-1 bulls to bears, 28-13 there. Despite losing over 2% on Friday. There's your big small cap underperformance, down 3.61%, 314 bulls, 368 bears. Now, with the sell-off in the market, with the global growth fears increasing, bonds had a strong rally, sending that 10-year down below 2.45%. We saw some inversions on newer parts of the curve last week as well. According to the Chaikin Power Bar, small cap stocks are somewhat more bearish than large cap stocks. Major indexes are mixed. Remember our strategic view. We prefer large over small. We prefer growth over value. Nothing that happened in the tail end of last week changes that view here in the near term. But from a tactical standpoint, our large cap growth plays are overbought. Our stock of the day, Triple S Management, ticker symbol GTS, comes to us from the Medical Care Group. Now, the stock was down 5.75% on Friday to close at 24.42. Chaikin Power Gauge rating for Triple S Management is very bullish due to very attractive financial metrics, very strong price volume activity, as well as strong earnings performance and positive expert activity. So when we roll up the 20 factors within these 4 categories, we kick out with a very bullish rating. Now, we have a very bullish stock with a strong trend, but a weak industry group. So, all right, remember, it's a weight of the evidence approach. Here's our very bullish rating. Been on that rating since late January. Stock's been outperforming the market since early February. So market and model are in agreement. Dynamic duo in gear here. But remember what I said about the broader market. We're not going to be aggressive on the long side just yet. And our overbought, oversold indicator is closer to overbought. Money flow is bullish but waning. We're above the rising long-term trend line. For me, there's a couple of ways to play this one. If you really want to get involved, I think as long as the stock is above $20, you are okay to be involved on the long side. I realize that that's kind of extended to the downside from current levels, but it's just the case. I think you want to use a pullback towards the 20 to 22 range to get involved in this stock, or you could play a breakout through 27.5 should the market give you that signal. I don't think it's there right now. GTS, Triple S Management, going to go on a bullish watch list. I'm just not being overly aggressive on the long side of the portfolio. Given the overbought nature of the market, I want to give it some time to settle out and set up a better tactical entry point. Now, our sector tracker, tracking the movement of the major sectors over the last 5 days. Discretionary at the top of the list, largely due to strength in Amazon. Remember, growth. The FANG names, we showed the chart on Friday, the FANG names are beginning to outperform. Large cap growth is a strategic overweight as far as I'm concerned. Real estate, staples, and utilities show you the defensive posture of the market, and tech rounding out the top 5 of groups that are up over the past 5 days. Remember, large cap and growth are strategic overweights in this environment. Tech certainly fits the growth bill for the most part. Now, at the bottom of the list, financials have just come under immense pressure. The banks were big underperformers on Friday and all throughout last week as the 10-year yield has continued to break down. Materials, healthcare, and industrials, the bottom of the list as well. Remember, we've been talking about the relative strength in healthcare, how we wanted to see a stabilization. We're not seeing it just yet. Industrials, I really thought we were going to get a better pullback, still above the levels where I like being involved, but it's really trying my patience. Energy and comms, middle of the list. Remember, energy is a group where we've been pointing out waning downside momentum. The short there is not as compelling as it had been in the past, so just something to keep in mind. Our industry in focus today is healthcare services, which over the past 6 months has underperformed by nearly 11%. Remember that underperformance in healthcare in general. Power bar ratio, however, is neutral. 9 bullish or very bullish stocks for 9 bearish or very bearish stocks. It's currently ranked, right kind of in the middle of the road. 12 out of 21 subsectors that we track, and it has moved up 3 slots over the past week. Now, with a neutral stance from the power bar perspective, your stock selection really becomes important, and you want to avoid the very bearish names. Some of those that we're seeing here, PetQ, P-E-T-Q, Acadia Health, ACHC, and Addus Home Care, ADUS, all with very bearish ratings. So those are names to avoid. Potentially even look at opening bearish positions. And one that I think looks compelling here is this Addus Home Care. Very bearish stock for ticker symbol ADUS. Weak trend, weak industry group type of name we want to consider as a bearish idea, or at the very least, be avoiding. Now you can see this rounding top pattern below the declining long-term trend line, but let's run through our analysis. Very bearish stock has been since January. Underperforming the market since mid-January, with the intensity of that underperformance increasing. Market and model are in agreement. Money flow is neutral. Stock is overbought. We do have a relative strength sell signal today. I think Addus looks compelling for an entry on the bearish side of the portfolio. If you do choose to trade that way, look for options. Bearish vertical put spreads to take advantage of what we think could be further downside in ticker symbol ADUS. U.S. Now, our trending names, yesterday's S&P 500 or Friday's movers and losers. Tiffany up on earnings. Verizon, a defensive play, trades higher to 2.5%. ConAgra's earnings sent that stock higher by nearly 2.5%. And Smucker's SJM goes along for the ride with ConAgra, as does General Mills. Now, General Mills had a generally positive print earlier in the week. Some of these staples seeing some defensive rotation, so General Mills follows through, also rises on the ConAgra print. Silicon Valley Bank hit hard, down 7%. BHF, part of the financials group, again hit hard. No real news to send URI down by nearly 7%. Nike's earnings were good, but expectations had become elevated. That stock down 6.61%. Western Digital down 6.5%. No real company-specific news that I could see to send that stock lower on the day. So let's dig in now. What are we talking about? Here's our 10-year yield. We've been talking for a while that we thought the path of least resistance for the 10-year yield was lower, especially on a break of 2.6%. That has played out. It's played out rapidly. We now look at support in the 2.4% level as a potential near-term bounce, but now 2.6% becomes resistance. RSI firmly in bearish ranges. Now, we do have an oversold reading, so I wouldn't be surprised to see a bit of a stabilization down here around 2.4%. But again, pressure, especially when you look at our 10-year yield within the context of global 10-year yields. We are the best option from a relative standpoint. I think that will attract flows, continue to pressure yields. Obviously, that's going to have a negative impact on the financials and continue to help the bond proxies like REITs and utilities. So just something to keep in mind. Small caps, they are nearing relative support, but this is just not a good-looking relative trend. IWM relative to the SPY is the chart in the top of the panel here, below the 200-day moving average, clear downtrend since making a high back in the June-July timeframe of 2018. What's also worrisome to me is that the RSI has broken a string of higher lows and has now reached an oversold reading, confirming that weakness in trend. When we look at it on an absolute basis, we can see that IWM is fading from support and likely going to continue to trend lower on an absolute basis. Remember our strategic positioning. Again, we favor large over small. We favor growth over value. So we continue to want to skew the portfolios in that manner, whether you're trading through ETFs or just when you're setting up your individual stock positions. It's something to keep in mind. Small caps are likely going to face a headwind here in the near to intermediate term. We want to continue to underweight that group. Commodities, though, are showing signs of life. Here's the Invesco DB Commodity Index Tracking Fund. We can see it's retaken the 50-day moving average, which is now rising, still below the 200-day moving average, and have some work to do around the 1650 level from a price-based resistance standpoint. However, should yields continue to weaken, to the extent that pressures the dollar, we would expect a tailwind to commodities. We've seen oil rally nicely, probably a little bit overdone here in the near term. I think gold looks compelling. But as we look at commodities as a group, you can see the RSI remains in bullish ranges, and Chaikin money flow is bullish as well. So look to your commodity plays, either through the ETFs or through individual stocks when they become oversold. The leading names that become oversold could be compelling entries on the long side. And as we look for gold here in particular, is gold set to retest the highs? We think so. Here are gold futures retaking the rising 50-day moving average above the 200-day moving average, which is shifting from declining to flat. RSI failed to become oversold during this pullback, so that gives us a clue on the strength of this uptrend and increases the odds that we're going to test the highs in the 1350 to 1360 zone. So gold looks like a compelling setup here from a portfolio positioning standpoint. That's going to wrap us for today. Sign up for the email, Daily Stock Ideas, in your inbox every morning before the market opens, chaikinanalytics.com/today. Special thanks to stockcharts.com for hosting this show. Special Thanks to See It Market for posting our work every day. I will be back here tomorrow.